the IBD investing methodology, we talk a lot about position sizing. Knowing how to appropriately size your positions is key to successful investing. There are various ways to determine an initial position size based on your conviction in a given stock and the overall market. Once you have that, then you can add to your position as the stock passes new bullish entries or pulls back. One method of determining position size is by limiting any full position to 10% to 12.5% of your overall portfolio. This way, you limit the total number of stocks in your portfolio to between 8 and 10 at max at full position. Depending on how much conviction you have in a given stock, you may choose to start your position at a full size, or 10%, or maybe a half size, or 5%, or a quarter position at 2.5%. But what if 2.5% still feels too big? What if underlying market conditions are so unstable or the stock you're looking at feels too risky to invest 2.5% of your portfolio? In this situation, you'll want to use what's known as the pilot position. This is an important tool for every investor to have in their toolbox. I recently spoke with IBD's head of market research, Justin Nielsen, who explained what the pilot position is and when to best use it.
I always think of pilot positions as being similar to the pilots for TV episodes. Why would you do a pilot for a TV episode? Well, before you go into the cost and risk of making an entire season, you make a single episode and then you kind of gauge interest, right? Is this something that's gaining traction in the marketplace? Are there interested parties from different networks? Is it worth the risk of going through a whole season? And you can do a lot of that by seeing how that pilot is received in the TV world. So let's kind of translate that to a position size. Well, maybe instead of taking your full position, you want to have less risk and go with a smaller position to start.
This essentially allows you to gauge market feedback incrementally. It allows you to test the waters a little at a time to see if this is working or not without a sizable risk on the line. Instead of a 2.5% quarter position, maybe you start with just a 1% position. The pilot position can also be used to put limits on yourself when your investing is maybe a little off. Maybe you've had several losses in a row and you need to give yourself some guardrails. Or perhaps you're testing out a new buy signal that you don't have any prior experience with. All of these can be valid reasons for trying out a pilot position instead of a bigger position.
I actually think of kind of 3 reasons why you might do it. Number 1, you're in a market environment that's a little bit riskier. So you want to go with a little bit of a smaller position to see if you can get anything to work, especially in a bad bear market. Number 2, you might be looking at a situation where you have a more volatile stock. And based on your entry, the most logical stop is a little bit further down than you would like. Maybe it's a more volatile stock. And so you start with a smaller position to just kind of manage that risk. And then a third might be that you are taking on an earlier entry or a different kind of setup, and maybe it's more failure prone. So before you put the full position to work, you start with a pilot position with the idea that if it starts working, again, that market is giving you the feedback, then you'll add to the position and take on that higher risk.
Now, once you've initiated the position and it starts to work in your favor, it's time to build out the position further. But Justin warns that with pilot positions, this gets a little bit tricky. Normally, when we're building a position, we do so in the typical pyramiding style. Say your ultimate goal is to have a 10% position as your full size position. Your first buy would be 50% of that 10%, which is 5%. Then you'd add another 30% of your full position size after the stock makes some progress, or as it triggers an alternate entry point. And then another 20% after more progress is made to fill out the remainder of that position. So as you can see, we ideally start with a nice base to the pyramid. Then each subsequent buy is a little smaller. That makes it so the average cost of the position doesn't go up too much.
If you're starting with a much smaller position, then there's a risk that you have here. And the risk is that you don't get enough money into the position if it starts working. So I said that there was going to be some math. So let's give an example. Let's say in a normal position size, You do a 12.5% position. That basically means that you're limiting your portfolio to about 8 stocks, each one, 1/8 is, 12 and a half. So if your full position size target is 12.5%, and you're willing to take a loss as much as 8%, that's our 8% stop loss, well, then that's going to be a 1% hit to your portfolio. So if you do a much smaller position, let's say you do a 1% position, and if that goes down 8%, well, that's not anywhere near a 1% hit to your portfolio. That's a fraction of a percent. So much easier to stomach that. But here's the risk. What if that 1% position, if you never add to it and this becomes a big winner? Well, in a 12.5% position, you get that thing to go up 10%, and you've done a good job in terms of moving the needle on your portfolio. Your portfolio is going to go up more than a percent. Okay. But if you have a 1% position, you need that thing to double just to get a 1% gain for your portfolio. So it just doesn't do that much. Now, again, on the downside, it doesn't hurt you that much, but it also, if you're right, it's not going to do that much unless you put more money to work.
Going back to the TV analogy, if you create a pilot but never create the series, how will you ever make any money off that investment? There's no merchandising opportunities or second season options if you don't invest the money to follow through on it. So it's important to realize that you're going to have to act quickly if it starts working. You also have to be aware that it will up your average cost in the meantime.
It is important that if you're going to start with a smaller position size, you are looking for opportunities to increase that.
All in all, pilot positions can be very helpful for managing risk in tricky market environments, but it's important to recognize when your position size is too small. If you are right, then it's not going to do much good for your portfolio. It's important you're always checking in with these stocks to see where and when you can add to them.